Let's dial it back a little bit. You did expect the S&P would break those prior June lows. They did that. We got this snapback rally. What's your read on the sustainability or the vulnerability of this rally?
Yeah, so I think, first, if we're just looking purely at the S&P 500 in a vacuum, we tagged the 200-week moving average to the penny essentially on Friday. That was around 35.90. There's a lot of analogies brought up to the market bottom in 2018, December of 2018, because we did the same thing. A key difference, though, by our work was back in December of 2018, you had a VIX curve that was 12 points inverted, meaning spot VIX was 12 points higher than the second-month future. And that typically, once you get over 10 points, that puts you in the ballpark of sustainable market bottoms. But the low on Friday, we only saw about a 2-point inversion. So we just haven't seen enough of that metric for us to want to call a durable bottom. And then when you look at the macro cross currents, the key drivers of equities all year continue to be interest rates and the dollar. And we just don't see enough evidence that those have peaked. I think there was a lot of optimism that rates and the dollar put in a top earlier this week, but then you see, what happens the last couple of days, the 10-year back above 380, dollar index back above 112, inflation break-evens have been up the last 4 days. So, I think it's just premature to say that the macro headwinds have become tailwinds for equities yet. Right.
Yeah, no, there's certainly been not an all clear on that front. What do you say to those who are kind of looking at some of the mechanics of the two-day rally and saying it was unusually strong breadth? We finally got a real dominant move to the upside in the very short term. Now, of course, there was a lot of that talk also in June, but it was followed by, a 17% rally over a couple of months. So does any of that hold up?
Yeah, I mean, there was a plethora of data analysis going on over the last couple of days. I think what's notable about these big breadth moves and big moves off the lows, you tend to see them right at the beginning of new bull markets, but you also see them in the middle of bear markets. That's what makes things so difficult to try to identify, and that's why we go back to some of those other metrics. Look, I think the back-to-back 90% upside volume days we had Monday and Tuesday, all else equal, that is more of a bullish sign than not. We looked, I think, August 2011 was kind of the one notable failure in the last 15 years or so, where you had that in late August 2011, and then you went on to make new lows about 12% lower. So there have been failures of that. I think, again, one other key, big picture metric we just highlight, the monthly RSI in the S&P 500 only got down to about 43 as of Friday. In the entire history of the S&P back to 1929, we've never bottomed after a 20% drawdown or more, unless you've got that monthly RSI below 42. So again, you could argue we're close enough, but history says there's enough things that say we're not quite there yet.
Yeah, it's really tough. There's the judgment calls kind of pile on top of each other when you're trying to figure this stuff out. Thanks for walking us through some of it, Jonathan. Appreciate it.
Thank you.